Good morning and a very warm welcome to this very special edition of Financial Fitness Fridays. This is obviously Money Talk Week. And so today we have the usual format. For those of you that haven't attended one of these sessions before, we're going to run for half an hour. I have a special guest. We're going to be talking today about budgeting, saving and investing. I'll tell you a bit more about that in a second. We're going to run for half an hour and we will have a hard stop then because I know some people have got other meetings to go to. Those of you that want to stay on, you can, and then we have a Q&A session afterwards. Now there is a Q&A button on your Zoom account, and what you can do there, if you've got questions, pop them into there along the way, and at the end we'll go through those questions. We'll pull out the good ones where the answers can help the rest of the audience. So thanks very much for jumping in today. We also have a Financial Fitness Fridays YouTube channel, and as we go through towards the end, we'll give you the links to that with all the back catalogue of topics that we've been covering for the last year or so. So budgeting, savings and investment, what's it all about? Well, you know, in my industry, it's full of very good, well-meaning people, very bright people. But when they come to do financial education, it can be a bit dry. And so what we've done with this one, we've tried to make it a bit more interesting. So we've got, you know, a live TV talk show style event. And the key thing here, sometimes why it is a bit dry is because really 80% of any success in life, when it comes to our finances, is our mindset, it's our psychology, it's our goal, it's our purpose in life. And so we need to have a good combination of the motivation to want to do these things, as well as then learning some of the mechanics and some of the technical stuff that we need to learn along the journey. So sit back, relax, enjoy. There will be a recording available on YouTube very soon about this. The good news is, you know, most people in my industry, when they do any kind of financial education, they're also trying to sell a product or a service. And the good news, we're not doing that. There's no product selling, there's no promotion of anything. We're just sharing wisdom with you. So I'd like to, without further ado, I'd like to introduce our special guest, David Stockdale, who's a private wealth advisor from Foster Denovo. I've known him for a long time. David, can you reveal yourself, please?
Hi, Darren.
Morning. Thanks very much for joining us today, Dave. Really appreciate it. How are you?
Yeah, good. Thanks. Very good.
Good. Well, I'll put you on the spot a wee bit because you stepped in at the last minute, but David is one of the industry's finest, so I'm sure he'll handle himself very well. I've been doing this job for a long time, same as you, Dave. We've known each other for an awful long time. This is about budgeting, savings and investments, and sometimes these things sound a bit dull, but you know, living within your means, saving first before you spend, and investing, these are really important things. So let's start with the first one. And the question is budgeting. Now, why do you think, Dave, that budgeting is so important?
Well, I guess the way I view this is that, you know, assuming somebody's working, they've got a level of income coming in and they've got a bunch of expenditure. And if that's not managed correctly, what happens with a lot of people, they get into debt because basically they spend more than they earn. And so the reason budgeting is so important is that, you know, one needs to be able to determine what their expenses are and, to be fair, live within their means. And we've often thought that expenses can fall into three key categories. The first one is fixed costs. Everyone's got certain fixed costs, which is basically your mortgage or your rent or your utilities, insurances and the like. And you can't really do too much about those because they're set up and fixed every month. The thing that you can control is what's called discretionary spending. And we suggest that falls into two categories. One of them is leisure, going out for dinner, buying clothes, maybe there's a few gifts. And then you've got luxury, which is, you know, big ticket items or large holidays. And if you don't have a budget, you won't know how much you can really spend on your discretionary spend. And as I said, that's why a lot of people start drawing down on credit cards and the like, because they end up spending more than they earn. So the main reason to do budgeting is it helps you stay within your means.
Yeah, and I think from a financial well-being perspective, in order to have a good sense of financial well-being, you need to feel in control. So I guess budgeting is a good way of doing that. And also I think I did it myself, and I did a budget planner, and I was quite shocked. And sometimes that little shock sometimes is what you need to make better decisions. So I think the two elements to that. But when you've introduced it to your clients, David, what experiences have you found with that? Because, you know, for me, it was very difficult to get round to doing it. You know, so do people kind of receive it differently? What's your experience?
Yeah, I think you're right. People receive it differently. I think for a lot of people, I mean, somebody who's maybe is in their 30s or 40s, it's possibly a bit insulting to suggest they should start filling in a budget plan. It's the sort of thing that you do when you first buy your first house, or maybe it's when you're a student. But my view is that everyone should have a budget planner. It doesn't matter how much money you earn, how much money you've got. I think it's a sensible thing to do. You're right, we do get a bit of resistance. Some people don't really want to do it. Some people are a bit nervous about doing it because there's a bit of a shock to the system when they realise how much their expenditure actually is. And for a lot of people, it's quite cathartic because it enables them to realise that actually their costs are quite a lot lower than what their income is, which means they have got more money to save than they originally thought, perhaps.
Yeah, I can imagine. I probably procrastinated for far too long on that one, for sure. So if people want to go and do a budget planner, and we would highly recommend that they do, and I think if you can just commit to it for 10 minutes, once you get started, you get going, then you start to see some of the expenditure, and if you do get that little shocking moment, you know, every decision we make in life is driven by emotion. Sometimes we need to get there, to get that feeling, to then make those better decisions. If somebody wanted to do it, Dave, not everyone could go and see a financial advisor, but where could people go and actually access a decent budget planner if it was like online or something like that? Where could they
I think nearly all the banks have them on their portals. Citizen Advice have them. Moneywise has them. You know, I think, to be fair, if you simply put budget planner into Google, I think you'd find one quite quickly. So I think they're readily available. And as I said, I think it's a good idea to consider breaking it down into different elements of one's life, and then that's a good way of determining which are the ones that you can basically manage.
Great. So one of the great things that comes out of budgeting is you learn to live within your means, which I think is a great habit to take through. I mean, we've been doing this a long time, David, and I had clients going back 30 years ago that I got into good habits from an early age. And one of those habits was not just living within our means, it's actually saving, you know, and using the concept of saving first and spending what's left. It's kind of a mantra from Warren Buffett. So once someone is convinced that for them saving's a good idea, where should they start, David?
Well, I think to your point, I think the first thing is, I think it's a bit of a hurdle for a lot of people to actually decide they're going to save. And I think our view on this has been as similar to what you said, Darren, is that, you know, most of us are paying the mortgage company, car loan, we're paying the supermarkets, the utility providers, the holiday companies. And the question to ask yourself is, how much do you pay yourself? You know, of the money you earn, how much do you keep for yourself? And the view we've always had is that you should save 10%, a minimum of 10%. So if you earn £500 a month, you should earn, say, 50. And if you earn 1,000, you should save 100. If you earn 10,000, you should save 1,000. And that should be the minimum amount of money that you spend, that you save. So I think the first thing is to decide on a quantity and an amount. And once you've done that, it's a case of deciding where that money goes. And you know, I would suggest that you've got a number of options there to answer your question. The first place that money should go is into short-term savings, which is basically into a building society or national savings where it's instantly accessible.
Are you referring there to what people call an emergency fund?
Yeah, I think before you start investing money for the medium and long term, you've got to have complete financial security that if your circumstances changed or you suddenly need to get hold of some money, it's readily available. Yeah,
I think I've talked to lots of people about emergency funds over the years, and I think the key thing is what is it there for? It sounds obvious for an emergency, you know, but I think it's there to prevent us going into short-term debt or high interest debt, because sometimes we get those challenges in life that come at us we can't plan for, where we have to find the money, we've got no option. If we haven't got the cash to one side, then we're tempted to go into debt and start that process of going down the wrong road with high interest debt and credit cards and overdrafts, etc. In terms of the emergency fund, though, Dave, is there kind of any rough rule of thumb how much people should have in an emergency fund?
Yeah, I think the guideline we give that people should have probably a minimum of 3, maybe 6 months net income. So if your net income was £1,000 a month, you'd have between £3,000 and £6,000 sitting in a savings account. If you earned £5,000 a month, you'd have between 15 and 30,000 sitting there. And the reason it's linked to your income is your expenditure is going to be linked to your income. If you lost your job or were made redundant or your circumstances changed, you need to make sure you're not under short-term financial stress. So that would be the kind of quantum we'd suggest, Darren.
Brilliant, thank you. So I just want to talk about a concept. Can you see the screen there?
Yes, it's come up now, yeah.
Yeah, so this is something which a lot of people have spoken about, and I think we're just trying to help people understand this concept. It's the concept of pound cost averaging. So I'm just going to kind of run the animation. If you could just tell us a bit about what this means, Dave. So this is an individual who was saving £100 a month over 2 years, 24 months. The fund they're investing into, there's two funds. There's a fund here which just goes up in a straight line for 2 years to 12%. There's another fund they could be investing into which has gone down and recovered a little bit, and it's actually over the 2 years done -2%. So if they're investing on a monthly basis, though, the fund that's gone up in a straight line is worth 2,538, whereas the fund that's gone down and up again is worth 2,603. So could you explain this to people, please? Can you explain what this means?
Yes, this is all relating to now investing money, which is different to what we just spoke about, which is saving money. So if you put money in a bank or a building society, or what we like to recommend, which is national savings, which is basically the government-backed savings program, that money is guaranteed up to a certain level, 85,000, and you get a small amount of interest on it. So it can't go down. It's 100% safe. And you get a little bit of interest, and that kind of interest at the moment is around 0.5%. It's very, very low. What Darren's now showing you is an example of you invested the money. So if you invested the money, investing money is different to saving money. Investing money is basically an investment, and in simple terms, that usually means investing in shares of companies in a fund that can go up and can go down. So the black line is giving an example of you put some money in at a particular point in time, and the market grew by 12%. And so at the end of the term, your fund is worth 2,538. Whereas if you put the money at the beginning on the orange fund and tracked it, at the end of the term, you would have less money. But when you invest monthly, what happens is you buy in at the various prices along that line. So with the black line, you would have bought in consistently at a price that was slightly above the previous month. And over the whole term, you've made your fund of money into 2,538. In the orange line, what happened initially is that the prices you were buying at were dropping. So you're going lower and lower and lower. But if you look at the way that curve works, what happens is that a lot of the money that you bought was at a price that's lower than what it is now. And just the way the maths has worked in that scenario, you know, in the example that we're looking at, you paid in 2,400, and the amount of value you have is greater with the orange line than the black line. And so we've often said to clients who are thinking about saving money for the first time, you know, with that in mind, putting money in on a regular basis actually is lower risk because you're not putting it all in at one price. And there is a possibility, quite a high possibility, you'll be better off doing that than if you put all the money in at once.
Thanks, David. And so when people talk about saving, I mean, my understanding is that, you know, it sounds logical and obvious, but in order to get us going, sometimes we need a big reason why, maybe a bigger purpose. Have you found that with your clients?
Yeah, I think inertia is a good reason for not doing anything, which is why, unfortunately, you meet people sometimes in their 30s, 40s, 50s, and they still say, I haven't got a pension, or I haven't started investing, because they just never got round to it. And as we both know, the longer you leave it, the more painful it will become. So starting off, going back to my original point, at an affordable amount on a regular basis. So our view is you get your short-term savings sorted first. And once that is achieved, you then say, let's start investing money. My view is you should only keep enough money on deposit for what you need for short-term emergencies or specific needs, because otherwise it will just get eroded by inflation. And we can look over any time frame, and being invested in the markets will give you better returns than staying in cash.
Absolutely. So that sort of leads us quite nicely into investing. And I think there's a lot of people a bit scared of this because it feels a bit risky. And, you know, there's a lot of us have heard about things called ISAs. and there's a cash ISA, and then there's a stocks and shares ISA. And sometimes I think that language is a bit scary for people. And so the majority of people in ISAs, they kind of take out an ISA because it grows tax-free. But if it's in cash, then that tax-free element on not very much return is not very much. So why is getting invested a good idea? Isn't it a bit risky for people?
I don't think so. No, I think not investing is what's risky. And the reason I say that is that when people talk about risk, it's what are we talking about? So if you have money sitting on deposit, the risk is it gets eroded by inflation. So in real terms, everyone's talking about inflation at the moment, increasing. It's increasing in America, it's increasing in the UK. Energy prices are going up, food prices are going up, everything is going up, the cost of living is going up. So if you've got your money sitting in a bank that's paying you 0.5%, in real returns, your money is dropping in value. So that is a risk. If you invest in the market, let's just talk about the stock market. Let's talk about something that everyone's familiar with, the FTSE. The FTSE is the UK stock market. It basically is an index that tracks the largest 100 companies in the UK. Okay, so when we talk about risk, what the risk is the price of companies goes up and down. So if you invest in shares, they could drop in value. If you look at what happened in COVID, the stock market dropped by 25%, but guess what? It's recovered and it's back to where it started. So there is short-term volatility, and volatility means the price of something changes from its usual course, and the higher the volatility, the more it will bounce around. So if you invest in the stock market, you need to be prepared for the fact that your price of your units or your funds or your shares can go up or down. But over the medium to long term, history has shown us over every time frame, you're significantly better off than leaving it in cash.
Let me share with everybody something to back that up, that point up. I'm going to share screen again. I'm going to go back to that slide there. I'm going to just flick forward. Can you see this one? Okay.
Yes.
So this is sort of supporting what you were talking about. And this is a slide that we've used to help people who have got savings in cash ISA, for example, and they're a bit reluctant to move across to the stocks and shares element of an ISA because it feels like a big step. So what we've done here, we've looked at inflation, because you mentioned inflation is the thing that will erode the value of cash. I think America announced a very high inflation rate yesterday, didn't it? I think it's 6.5% or something. So that just is like a tax on our money. And what we put together here was something to give people confidence. So to back up what you were saying, Dave, these are some actual facts. So what we've looked at is 5-year periods ending across various times. So 2006 right through to 2020. If I put the first animation up, you can see that's inflation over that period. So we've got, 2007, for example, the end of the 5-year term ends in 2007. We've got about 18%, something like that. 2016, it was lower. So then we put in cash. Let's look at what cash has done. And again, for a lot of people, this is with their ISAs. You can see in the last decade, inflation has outperformed cash pretty much every single year. So that is what is doing what Dave's saying, which is eroding that buying power, that true value of that money. And then investments. Let's look at investments. This is based on stocks and shares ISA. And when you look at it like that, it's almost a no-brainer. You can't look at it at less than 5 years. You've got to look at 5 years. Look at that. When it hasn't performed as well, it's not disastrous. But when it's up, the upside is pretty phenomenal. And so I think the key thing there is, David, can you just talk about that slide and some comments around it, and also about timing or time in the market?
Yeah, so I think what that confirms what I was saying earlier, that over most periods, you'll get better returns from investing your money than you will in cash. And in fact, looking at that chart, other than in 1 year, 1 5-year period, that's the case. So investing the money is going to give you better returns than investing in cash. And on occasions, you'll have a situation where the inflation is greater. And the reason inflation can be, and in those circumstances, it's usually a market event like 2008, which has been an unexpected crash. I think what that demonstrates is that for most people, if you're investing for the medium to long term, and it probably is in something like 95 or 90% of cases, you'll be better off being investing. And the chance of you beating inflation in cash increases with time. So the longer you invest for, the more likely it is that you will outperform inflation or cash. If you go for a short term, and if somebody said, I've got some money to invest, I'm going to use it in 12 months' time, we would not suggest that money is invested. We'd say it stays in cash because the time period is too short. And to your point, because markets move around quite a lot, there are plenty of people who suggest they know what's going to happen to the stock market and the economy, but the truth is they're all educated guessers and nobody knows for certain. So the view is you can't time when you go into the market. What you need to decide is, I want to be invested, start putting money in and hopefully leave it in for a long time. The longer you leave it in, the greater the chance of you getting very good returns will be.
So I think that sets up the statement, it's time in, not timing.
Correct, that's right.
Yeah, I think the great thing about this from a psychological standpoint is we've got to try and overcome that psychology of investing. You have what drives investors is fear and greed. And if the markets are going up very high, they feel like they're missing out, FOMO, and so they then get in when it's high and then it drops. It drops and they get out when it's low. It's just a matter of just sitting it out over time. And as those figures suggest, over almost every period, you're okay as long as you stay in the market. And the other great thing about it from a psychological standpoint is once you start to focus on what it is you're trying to achieve, you start to set some goals, get into some good savings habits, start to build your wealth, you get into a whole new mindset. And this is so important, and it stops us making some very rash decisions. I mean, the psychology works against us when you use like social media. Social media is always bombarding us with adverts because it knows what we're interested in. So Google and Facebook will be bombarding us with stuff, and it creates a psychological urge to have the thing they're bombarding us with. And then Amazon come along, and the mechanics side of it is quite easy. Buy it now, get it tomorrow. And so they kind of use it against us. So the good news is if we've got a plan, we've got a wealth improving, we've got into good habits, I think we can be much more aware of those urges and actually add it to the cart, sit on it for 24 hours, see if we really do want it the next day. So thanks very much for that, Dave. So I think what you sort of said there, that is if you're investing for the medium term, this is more risk leaving it in cash than it is in the stock market. Is that right?
Yeah, I think so. Yeah, I think that when people talk about risks, it's the risk of what everyone at the moment believes that a lot of people believe investing in the stock market is risky, but as we just demonstrated, over the medium to long term, in fact, it's leaving money in cash that's risky. What we'd also always suggest is that if you invest money, when people talk about stocks and shares ISA, for most people, that will be invested in a range of companies. And if you diversify by having your money in more than one company, for example, you clearly have got, it irons out the ups and downs. And the best example is if you looked at the FTSE, if you said, is it better to invest in a retail company or a bank or the FTSE, then we'd say, well, the FTSE has exposure to airlines, banks, retail, pharmaceutical, food, building companies, construction firms. So you're diversifying across sectors and companies. And for most people, when they first start investing, that's a sensible thing to do as opposed to buying an individual share that clearly has more risk associated with it.
And would it be fair to compare a typical stocks and shares ISA fund that's typically used, which would be a bit like that, to a pension fund that you're automatically enrolled in at work? Would it be fair to compare those two investments as quite similar?
Yeah, really, the underlying investments for these things is quite similar. And you can either, if you looked at let's call it a stocks and shares ISA, what that really means, it's an ISA that is investing in stocks and shares, and a pension can invest in stocks and shares, and a like unit trust or a general account, which is another form of investment, can invest in stocks and shares. So the two things to always think about when we're investing money: what is the wrapper, what is the product you're using, and then secondly, what is the underlying investment? And those underlying investments are available with all the products that you just talked about there.
Yeah, and I think the reason I put that point out there was to help give people confidence to take a look at the stocks and shares element of their ISA, because it doesn't stop them investing in a pension, so therefore maybe they shouldn't stop them investing for the medium term using their ISA. So if people wanted to go and get an ISA, Dave, any ideas where they could go if they wanted to find one? Because again, ISAs are not the sort of thing people generally take advice on their own, are they?
No, so I think to your original point, you're probably right in what you're saying, that the benefit of a cash ISA is negligible. And the reason for that is that, as you mentioned earlier on, you get tax-free growth. So let's say you've got £20,000 in an ISA and it's paying you 1%, which is £200. If it's tax-free, you might be saving £10 or £20. So over the medium term, it's a very small saving. With a stocks or shares ISA, where maybe you're hoping to get, typically people would talk about maybe 4 or 5% return on average for investing in the stock market. That being tax-free makes a big difference and is more attractive. To answer your question, you could get a cash ISA from your bank. Nearly all banks will provide, or as I mentioned, national savings. The reason we like national savings, certainly for larger sums of money, is because it's not protected. There's no limit to how much you can have in it and be fully protected. You can actually have £3 million. So we like national savings. If you wanted to invest in a stocks and shares ISA and you weren't dealing through a financial advisor, there are plenty of online platforms. Two of the largest would be Nutmeg or Moneybox. And both of those enable you to enroll in an ISA without taking financial advice. So you basically go onto the platform, it will ask you some questions about risk and how much you'd like to invest and try to help you, signpost you to choose the one that's best for you. And they're both readily available. They're relatively cost effective, and they've become very popular over the years.
Yeah, there's also, because I work in the employee benefit side of our business, there's an increasing number of the pension providers in the workplace that are opening themselves up to providing an ISA within the workplace. And a lot of the time it can sit alongside the pension pot, and using apps you can see both pots growing together. So that's growing. Certainly there's a lot of companies are moving down that road at the moment. So it might be worth checking, because the good news about that type of an ISA is that you could often benefit from the economies of scale of the pension. So what you could probably sometimes find is that the charges on the ISA are similar or match the charges on the pension, which are already very competitive. So definitely worth exploring that one for people as well. So I do need to we're just wrapping up, if we're going to Q&A, I'm going to just keep the regulator happy and just do a share screen and bring up the caveats before we end. So typically going very slow on me. There we go. So there's the caveats I need to put up there. So that's that done. So thanks very much for joining us today. Really appreciate it. Those have got to go. Thank you for jumping on board, and I really hope you get something out of it. The other place you can, not everyone can get financial advice or afford it. So one of the things we would say to you is that if you want to learn more about investing, go to the Financial Fitness Fridays YouTube channel. I think one of the girls that works for us is going to put that into the chat box. You can grab that link if you'd like to go straight to that. So let's see what sort of questions we've got so far. I'm going to have a little look. We haven't got, oh, blimey, we haven't got as many. You must have done a good job, Dave, because I normally get bombarded with questions. Let's see what we do have. So investment tools have got on there. Right. Let's have a look. Okay, somebody's just said the question, how many years count as medium and long term?
Yeah, that's a good question. I think that it depends in what context we're considering this. I think I would say for short-term investing and keeping money in a bank or on deposit would be anything probably up to 18 months to 2 years. So anything less than that, I wouldn't invest it for. We do talk about investing periods as a 5 to 7 year cycle. That's what people often talk about. But I think if you're investing money and say, is it worth investing if it's for how long? I'd say anything over 2 years, it would be worth investing money for.
Thank you. This is a really common question, so I'm going to put it out there. I get it all the time when I'm doing kind of financial education. What should I do? Is it worth putting in pension over ISA? When would you do both?
Yeah, so I think that I think my view is that most important thing is to sort out your short-term savings. Pensions are very, very tax effective because you get tax relief on your contributions. So if you're a basic rate taxpayer, you get 20% relief. If you're a high rate taxpayer, you get 40% relief. Now, we don't know how long that's going to last for. You know, we don't know what Ricky's up to and what his plans are about his changes to legislation in the future. So we think that's very attractive, but anything that goes into a pension is clearly tied up until you're 55. Anything in an ISA doesn't have that tax break, but is immediately accessible at any time. So I think it depends on your circumstances. If you're happy to tie the money up for long term because you've got short-term cash, pension, if you definitely need the money in the medium-term ISA, and probably as was asked by the question, really the ideal scenario is a bit of both.
Fantastic, thank you. Somebody's asked a question here about environmental ISA platforms. Are there any out there?
Yeah, so it's not really the platform itself, it's the funds you invest in. So it's a very good question, and there are more and more companies. In fact, nearly all fund management houses are looking quite quickly to introduce a range of funds that satisfy what's known as ESG, environmental social governance. So these will be companies that specifically are demonstrating they're good for society, they do the right sort of thing for the environment, and they've got very good corporate governance. So I think nearly all platforms, if they haven't done so, will be offering those kind of funds because there is a huge interest in them. And obviously, not only does it probably make you feel good yourself if you're investing in them, the general view is the companies that satisfy those three specific requirements are probably the ones that are going to prosper over the coming years.
Yeah, there's another question here I think probably will be verging into advice. Someone's asking an opinion on Vanguard. Is it a safe way of investing? Would you agree?
No, I can answer that. No, so Vanguard is probably the world's largest fund management house that specifically focus on what's called passive investing. So Vanguard are American, but they've come to the UK recently. They're very, very popular. And Vanguard, because of the way they set their funds up, they access world markets throughout the world. So if you invest in an Vanguard fund, almost certainly you will be investing a bit of your money will be Amazon, Adobe, Netflix, Alphabet, British companies, European companies, overseas companies. And so as a company, it is certainly one of the largest and high profile providers of accessing what we call passive investing, which is where the money isn't being managed, but you are basically in the market and you are benefiting from the performance of the underlying shares.
Brilliant. I've had a couple of questions come in regarding lifetime ISAs, so I'm going to kind of combine the two. For those of you that don't know, a lifetime ISA is one where you can actually attract some tax relief as well as on top of your contributions. So the first question is, if you're a 20-something, should you go for a lifetime ISA? And the other question that's related is, I'm looking to buy a house in the next 4 or 5 years, and I've used my lifetime ISA for saving towards the deposit. Where is best to put the extra funds, into cash or into the investment side of it?
So I'll be honest, I'm not an expert on lifetime ISAs. I think they are something that have only been provided by a small number of product providers. And as was asked by the questioner, that they were set up in a way to basically incentivize people to save, and the government said they would then give a top up if that money was then used for property purchase in the future. Their underlying assets are very similar. And regarding the second question, it depends very much. If your purpose for investing the money is to build up savings specifically towards, let's say, a house purchase in the next couple of years, then any saving should go on deposit. Going back to my original point, if your intention is that you're saving for the medium term, so 3-4 years plus, then that should go into equities, stocks and shares, ISA.
Brilliant, thank you very much. This is another good question, actually. Somebody's got an existing stocks and shares ISA. Can they swap it across into a new nutmeg stroke money box ISA?
Yes, you can do ISA transfers. You've got to be a little bit careful, because when you do ISA transfers, there are certain rules that then prohibit you from putting further money in that same tax year. There is an ability to move money from one ISA to another. I'd be very, very careful about doing that. Going back to what we both spoke about, Darren, it's all about time in the market. It's very tempting to move your money from A to B. Usually when you move your money from A to B, there are costs involved. There may be penalties. So I'd be quite cautious about that. There is nothing stopping you having a large number of ISAs. So if somebody built up an ISA over 5 years, and then this year they're looking to make another ISA contribution, that could go into a brand new ISA, and you could keep the existing ISA where it was.
Brilliant. Thank you very much. So I think there's some quite personal questions on here, which I think we should pick up separately. Just if anything else coming through that's going to be useful for Help to Buy ISA, that's the sort of predecessor to the Lifetime ISA. Someone says stuck with one provider, so lose interest on ISA allowance to save. What advice would you offer? Stop Help to Buy when year ends, or continue? You know much about Help to Buy ISAs, Dave? Was that not really your?
No, not really. I mean, I think regarding, I think people are asking a similar question though about once you've got an ISA, you can't pay into more than one ISA in the same year. So if you're paying into one already, you really could continue with that. It's my original point. If you've built some money up in ISAs previously, there's nothing stopping you starting a brand new ISA with another provider. You could have 2 ISAs, you could have 10 ISAs, but you can't invest in more than one in the same tax year.
And you just answered 2 questions which came in straight after. Can you have more than one ISA? So yes, but not in the same tax year.
Yeah.
So I think, apart from the questions are a little bit individualized, someone's asking for a recommendation on a good company for stocks and shares ISAs. Sort of mentioned that to a degree. I don't think we want to be making any recommendation. I think the
thing about if somebody like Nutmeg or Moneybox, they're all quite similar, because the fact is that they just ask you what your risk profile is, and they try and keep it simple and say high risk, medium risk, or low risk. And when you talk about risk, really what it means in this term is more in shares or less in shares. That's what that really means. And they're generally low cost, and they generally are quite passive, which means you're not paying a fund manager to manage your money. You're simply in the market. And therefore, a lot of these are similar. So going back to the question about Vanguard and BlackRock and Legal & General all run passive strategies. And because they're all tracking the market, they are all quite similar. So if your objective is to say, I just want in the market, keep it low cost, they're quite similar. If you're paying for active management, which is where you're getting somebody to help you, and that really, I think, is only relevant when you've got more money. For people who are starting off, my view is keep your costs low. You don't need an advisor to tell you it's a good idea to save some money. You can just go and do that yourself if you can afford to do it. And as I mentioned, there's quite a few firms like the ones we've said that would facilitate that. Brilliant.
There's a couple of points coming regarding mortgage or investing. So, I mean, it will depend a lot on individual circumstances, but general commentary, Dave, around, is it better to pay down mortgage or to invest?
Well, I think that's quite straightforward, really. It's a little bit like the argument about cash over investment. If your mortgage rate, we know mortgage rates at the moment. I'm meeting people saying I'm paying 1% in the mortgage, 0.75 or 1.25. The stock market went up 20% last year. Now, it doesn't always do 20%, and on average, it's more likely going to be 4 or 5, but it's certainly going to be more than 1. And so if somebody said, is it a good idea that I pay my mortgage off or I invest? Again, we can't give advice because we don't know your situation. Generally, I would say I'd invest, because you're likely to get a better return on your money than your mortgage rate. And secondly, you retain liquidity. If you pay your mortgage off, the money's gone. If you invest it, you've still got it. So in most cases, I think you should give serious consideration to saying, maybe as I keep my mortgage at a certain level, invest my money. What you shouldn't do is spend the money you're going to pay off your mortgage, because that puts you in a worse situation. But if it's investing it, in most periods of time, as you showed in your original chart, you'll end up being better off than if you paid it down.
Yeah, another good question has popped in, actually. Somebody said, is there a charge if you take money in and out of an ISA investment?
If you're going direct to these direct providers, the majority of them will not have any initial charges or exit charges, no.
Okay, brilliant. And there's another good question came in. Where is it? Yeah, it's an interesting question. This is for people probably thinking about paying for an advisor. What would you say is a reasonable percentage fee to pay for investing in a service?
I think that again depends on circumstances. As a general rule, most financial advisory firms in the UK still work on the principle they charge a percentage of the money that they oversee for you, and the most typical charge would be about 0.75%. Some firms would charge 1%, some firms may charge 0.5%. It usually will be in that range.
Okay, here's another question which a lot of people ask, probably worth getting your opinion, Dave. Which is best, property or investing?
So, yeah, that is a good question. What we're really saying is we're talking about asset types, okay? Investing in the stock market or investing in property. Now, this is very, unlike some of the other charts, there have been long periods of time where property has outperformed equities. We've talked, Darren, before about, you know, post or the Thatcher years, when council houses were sold to individuals, and individuals could buy council houses, and everybody was jumping on the property market, and property prices went through the roof. In fact, property prices have risen generally consistently, you know, since the 80s at a high speed. If you looked over the last 5 to 10 years, it's a different story. So my view is that if you could afford to diversify over property and investments is a good idea. For most people, however, having a property as your main home where you live, which really isn't an investment, it's your house, is an objective. Investing money, generally, you've got a pretty good idea of the kind of returns you're going to get. And the one thing is, it's definitely hands-off. So if you've got your money invested and you're the investor and you're using an advisor or platform, you don't need to get involved. You just let it do what it's going to do. If you're going to get involved in buy-to-lets, as an example, I know quite a lot of success stories. I also know a lot of horror stories. It takes a lot of time. You have no tenant. The boiler blows up. The mortgage company chase you because the price has dropped. It can be a lot of grief. So I'd be quite wary. I think if it's in your blood, you've got experience through your family, you know other people have done it, that's fine. But for a lot of people, I think they can be tempted into something that may not be the right thing for them.
Brilliant. Well, I think we've just about run out of time there. So I really appreciate you helping us out, David, today. Did an excellent job, put you on the spot there. A big chunk of the session was questions that you weren't prepared for, so that's good. I'm just going to paste in once more here the Financial Fitness Fridays YouTube channel link. I'll just do that for everyone. So if you want to grab that, and then oh, it didn't work. Okay, it's in the chat box actually. If you scroll up, you can grab that there. I tried to copy and paste, it didn't work. So listen, well done to everybody. Thanks for jumping on. We've got almost everybody still here right through to the end. So that says a lot about you, Dave. So thank you ever so much. And I'd just like to wish everybody every success on your journey to financial well-being. Take care and have a great weekend. Bye for now. Thanks again, Dave.
Thank you very much, Darren.